Welcome to today's episode of Easy Tutorial Concept. We'll be looking at change of accounting date today, which is one of the abnormal basis period. And it's possible that company may decide to change their accounting date or accounting year end, as the case may be, due to so many reasons. Maybe probably to have a uniform account date, it is a parent or a subsidiary. Now, whenever there is a change in accounting date of an organization, how will this business be accessible to tax? How do we calculate the accessible profit in order for them to be taxed? Now, there is a rule for change of accounting date. When a firm changes the accounting date, you will first of all identify the year they failed to make up accounts with the old accounting date. You have to identify that first of all. That particular year they did not make up accounts with the old accounting date. That becomes the year they fail to make up accounts. I'm going to give us several scenarios to test our knowledge on how to identify the year, because if you fail to identify the year the change occur, I think every other thing will be wrong, because you first of all have to identify the year they fail to make up accounts and 2 years following. Then you have to assess this total of 3 years, which is the year they fail to make up account, that's the year of change. Then 2 years following, making a total of 3 years. You will have to assess these 3 years using the old accounting dates. Then you also assess these 3 years using the new accounting date. Then you compare your result. In a nutshell, we can say the principles to apply when there is a change in accounting date is: 1, identify the year the business failed to make up accounts based on the old accounting date. Identify the year they failed to make up accounts based on the old accounting date. 2, okay, and you can say and 2 years following, the year they failed to make up accounts based on the old accounting date, and 2 years following. Then 2, assess the 3 years in A above or in 1 above. If this one is identify the year the business failed to make up accounts based on the old accounting date, and 2 years following, then your Roman figure 2 will be assess the 3 years in 1 above using the old accounting year end or accounting date. Then Roman figure 3, assess the 3 years in Roman figure 1 above using the new accounting date. Then Roman figure 4, compare your results. And one thing you should know, it is the revenue authority's position to determine which of them they will choose to assess the business with. That is to say, in commencement, the right of election lies in the hand of the taxpayer. So the taxpayer can either determine whether to use ASHWA or the basics of assessment given. So if we have old accounting, the higher your profit, the higher tax you pay. So if your old accounting date, at the end of the day, your accessible profit amounts to 100,000. Then for the new accounting date, it amounts to 150,000. The revenue authority will choose to assess you based on the new accounting date. You understand? So same as taxation, it is the revenue authority that has the right to select, and they will always select the higher of either of them. Now let's look at practical situation where there will be change in accounting date, or let's see how we can identify where a business, because if you can identify the year of change, first of all, if you identify the year of change and the 2 years following, I think you're already having a light into the calculation. Let's say for a business that has this information, let's say year ended 30th June 2016, year ended 30th June 2017, year ended 30th, okay, let's say period 2, period 2, 31st December 20, let's say 2018. Then let's say year ended 31st December 2019. Now for this particular question, which year do you think the business failed to make up account? Now not just fail to make up account, one thing that will help you is to use this clause. Which year did they fail to make up account with the old accounting dates? You understand? Which year did they fail to make up account with the old accounting dates? That is what will help you. Now if you look at this scenario, in some questions you see, you get to that scenario whereby there will be probably a jump or a gap in between the years. But for this particular case, they made up account 30th June 2016, 30th June 2017. Then in 2018, they did not end their account in June. They now extended to December. They changed to December in 2018. Then just like that. So if you want to practically identify the year they failed to make up account, the year they failed to make up account is 2018. How? This is how you know it. In 2016, did they use the old accounting date? Yes, they used it. You know, we say the year they failed to make up account with the old or based on the old accounting date. In 2017, did they use the old accounting date? Yes. In 2018, did they use the old accounting date? No. So that is the year of change. So practically, your the year they failed to make up account will be 2018, 2019, and 2020 will now follow. 2 years following. According to the rule, identify the year they failed to make up account and 2 years following. You understand? Then let's take another scenario. Let's say we have something like this. Let's say year ended 31st December 2016, 31st December 2017. Let's say period to 30th of April 2019. Year ended 30th April 2020. Now you agree with me that I think if you look at it now, there is a jump. 2018 is missing here, but you don't just use that jump or gap to get your, that will not be a base, and there will be no proof or no base to which you can justify that. Now the make up account to 30th December 2016, 31st December 2017. Then did they make up account 2018 with the old accounting date? No. So the year they failed to make up account with the old accounting date is what? 2018. And 2 years following with 2019 and 2020. So you see, they made up account here and they only spread 12 months, 12 months. Now in this period, they didn't just make up account to 12 months, which is about a 16 months period. Then just like that. So in this particular scenario, the year they failed to make up account based on the old account date is 2018. Because December 31st 2017 or 2017 they used the old accounting date, but 2018 they did not use the old accounting date, so it's not even here. So it was not added to the new accounting date. So the year they failed to make up account is 2018. Then let me give you the last scenario that sometimes might look complicated. Okay, let's say we have year ended 30th June 2019, 30th June 2020, period to let's say 30th September 2020. 30th September 2021. Now you are seeing two things there now. 2020, 2020 in one question. How is that possible? But when you know the principle, no matter how they try to twist the question, you always use the principle as a guide. Now, without even having to stress my mind, in 2019, did they use the old accounting date? Yes, which is 30th. Or it was the old accounting date is this one they normally use before they not change. Now, in 2019, they use the accounting date? Yes. In 2020, did they use the old accounting date? Yes. Now, they now also brought the new accounting date in 2020, but that does not concern us. Our concern is year after year. Which year did they fail? In 2019, they used the old date. In 2020, they used the old date. In 2021, did they use the old date? No. So my year of change is 2021. So it becomes 2021, 2022, and 2023. So let's take practical question to illustrate all of this. Okay, so this is a practical question to illustrate the explanation so far. ABC Limited for many years prepared account to December 31st, but decided to prepare a 16 months account to April 30th. So they are changing the accounting date from 31st December every year to 30th of April. The adjusted profits are as follows. 12 months to December 31st, 2015, the assessed profit is 180,000. 12 months to the adjusted profit, 12 months to December 31st, 240,000. 16 months to April 30th, 2018, and they've changed from December 31st to April, 336,000. 12 months to April 30th, 2019, 144,000. So what's the first thing? Identify the year they failed to make up account based on the old accounting date. In 2015, did they make up account with the old accounting date? Yes. In 2016, did they make up account with the old accounting date? Yes. In 2017, did they make up account with the old accounting date? Obviously no, because in 2017 they now added 2018 period to it to start preparing accounts to April 30th. So the year they did not make up account with the old accounting date is what? Year 2017, and 2 years following will be 2018 and 2019. So we bring the name of the company down. Say ABC Limited. Let's try to manage this space. Computation to be based on the requirements. Shall let's say required to compute the accessible profit for the relevant years. So computation of accessible profit for 2017, 2018, and 2019 year of assessment based on the old accounting dates. So whenever you see questions like this, nobody will tell you whether to apply what's it called? Change of accounting date principle. You don't need to be told whether you have to calculate this in change of account. In my previous video, we did commencement. We solved questions on commencement. So the questions determine the requirements. In fact, when you read the question, you should know the requirements without being told. When you see a question stating ABC commence business on so and so and so and so, you understand? In such case, it's a new business. Commencement rule will apply. But when you see for a subsisting business has been in operation before, they change the accounting date from a particular year end to another year end. You know that you have to apply change of accounting date. Then when you look at the question again and you discover that if they normally prepare account on 30th of April every year, then the last date they prepare till maybe March or February, they've ceased operation. Maybe they did not get to the, that's to say you have to apply cessation principle. So you look at the question to know what you're supposed to do. They may not say required using change of accounting date procedures. No. They might not say that. You might be asked to compute or advise the company based on the accessible profit or the accessible profit given above. So you know that you are to advise you are advising them based on you are standing as an intermediary to advise them. So at the end of the day, you have to tell them which of them the tax authority will assess the business with, because the decision to choose lies in the hands of the tax authority, the FIRS. Okay, so the old accounting date, we have year of assessment, basis period, and assessable profit. Okay, so we've identified that the year they failed to make up account based on the old accounting date is 2017. Then the 2 years following, 2018 and 2019. Please take note, for an existing business, the basis of assessment is on preceding year basis. Preceding year basis. Now, if this to assess 2017, remember it is based on preceding year basis, the year before. Remember that the accounting date is old that you have to assess first for identify the year of change and 2 years following. Then assess these 3 years using the old accounting date. What is the old accounting date? 31st of December. 31st of December. So they normally end account 31st of December. So if it is preceding year basis, which year comes before 2017? That is 2016. So if you count 12 months back, because you know an accounting period is a period of 12 months, it will be 1st of January 2016. So this is a period of 12 months. I know in this particular one there is no overlap. When we get to the new date, you see overlap where we enter another year. So without even having to crack your memory about how to run through this period, please look at our previous video on commencement. I explain detail how to write your base period either for preceding year or actual as the case may be. So look at that video very well if you are still confused. But by now you should be able to know that for 2018, if it is preceding year basis and the accounting year end is 31st December, it means it is from 1st of January 2017 to 31st December 2017, the year before, without wasting time. So for 2018, if they end account, which is the old date, they normally end account 31st of December. Which year comes before 2018? 2017. Count 12 months backward, it is 1st of January 2017. Then for this one, the same thing, so January 2018 to 31st December 2018. So I think for beginners, they will be doing this process, but those that are already experts in it, they don't need to count. They just, even when it is overlap, they know what to do, and so when you practice consistently, you definitely become a guru in this basis period matter. Now, you've identified, you've been able to draw the basis period. The next challenge that you have to battle with now is how to now fish out the accessible profit. Now, from 1st January 2016 to 31st December 2016, I believe is this period we are having here. This period here. Because if this place ends 31st December 2015, it means here we start from 1st of January 2016 to 31st December 2016. They made that much 240,000. That's the exact basis period we are looking for here. 240,000. Next, 1st of January 2017 to 31st December 2017. If this place ends 31st December 2016, it means this place starts from 1st of January 2017 down to April 30th 2018. Means a period of 16 months, January to April of the other year, 16 months. And we are looking for, all these periods are basically 12 months period. We are looking for 12 months, January to December. And now they gave us January to April, which is more than, they gave us January, February, March, April, May, June, July, August, September, October, November, December, January, February, March, April of 2017, and 4 months inside 2018 were given to us together in one period. They gave us January to April, but we are looking for January to December, so which is a period of 12 months. So they gave us a profit of 16 months. So you have to take 12, the 12 which is from January to December out of the entire 16, because the total profit given to us here is for 16 months. So you are taking January to December only. So you prorate 12 over 16 times 336,000, and that will give us 252,000. All right. The next 1st of January 2018, where does this period falls into? You agree with me that in this 16 months period that started from 1st of January 2017, it extended to April 30th, 2018. It means we have January, February, March, and April concerning 2018 in this period. 4 months of 2018, and that is January, February, March, April, is in this 16 months period. So you have to take that 4 months first before you take the remaining 8 months in the next period. That is to say, we have January to April in this period concerning 2018. We are looking for January to December, but they included January to April inside of this 16 months. So you take that at first. 4 over 16 times 336. No, it's a total period of 16 months in this place. So you are taking 4 months out of 16 plus the remaining month we have is 8. You know, we are looking for January to December. We're taking January to April, which is embedded inside this period of 16 months. Remaining May, June, July, August, September, October, November, December, 8 months, which falls in this other period. And this is the total period of how many months? 12 months. So you take the 8. 8 over 12 times 144,000. And when you add together, it will be 672,000. So remember to lay emphasis on this again, you know, where it now have the 2 fraction, you know, becoming one, solving to get one figure. This is from 1st of January 2018 to 31st December 2018. And you agree that January to April 2018 is added in this period. This is from 1st of January 2017 to April 2018. So we have January to April relating to this period. So you have to take that January to April first out of the total of 16 months. Take that 4 months, January, February, March, April, 4 over 16. Then the remaining 8 months, which is from April, May, June, July, August, September, October, November, December. You take from May to December, which is already in this next period. You take May, June, July, August, September, October, November, December, January, February, March, April. This is what we have in this period. So you take from May to December, which is 8, over the total 12. That's how we got 180. Now we solve the new accounting date using the same space as well. So without wasting time, the new accounting date, remember, the same year, the same what's it called? The same year of assessment does not change. So the only thing that will change is your basis period and the accessible profit. Okay. Now, what is the new accounting date? They now change the accounting date to 30th of April every year now. April. So if they will end account 30th of April, when will they start? So if you are not good at these things, or you've not mastered the creative art of writing basis period, then you have to read it manually. Now, remember, for every subsisting business or existing business, every existing business is on preceding year basis. So which year comes before 2017? It is 2016. Take note of that. Preceding year basis. When you add 12 months back, it will land us in 1st of May 2015. Do I agree with that? Okay, let's see. January, February, March, April, May, June, July, August, September, October, November, December 2017. Or let's say 2015 rather. 2016, 2017. January, February, March, April, May, June, July, August, September, October, November, December. Now, we say the accounting date, the new accounting date is 30th of what? April. So it means they are ending account 30th of April. Preceding year, which year comes before 2017 is 2016. So if you count 12 months back to know when will they start to have ended or to have reported profit as at this date, when did they start? Now please, follow, this is 2016 calendar now, and this is a 30th of April, this is April. Now let's count 12 months back. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So it means they started in which month? This is May. January, February, March, April, May. They started in 1st of May, 20 what? 15. Overlap. 2 period. So you see, the beauty of this thing is that when you practice consistently, you become a doing it. You don't even need to think. You don't need to draw calendar. You start writing, without stress, and even the completion of the assessable profit too. No stress. All right. So in this case, I think we've gotten a foundation that will help us to solve the other two. So same thing applies. If this is 2018 year of assessment, the new account date is 30th of April. Which year comes before 2018? It's 2017. 12 months back will be 1st of May 2016. Okay, so here 1st of May 2017 to 30th of April 2018. Like I said in our commencement video, it is very it is impossible and it is out of place to be sorting with preceding year basis and you see the year of assessment inside this basis period. Is an error. If you are using preceding year basis, on no account you will find 2017 inside this place, or 2018 inside here, or 2019. It should not come at all. Take note of that. All right, now let's put in the assessable profit for this respective year of assessment. Now for 1st of May 2015 to 30th of April 2016. This period falls in this first profit stated here. They give us January to December. January, February, March, April, May, June, July, August, September, October, November, December of 2015, right? 12 months too. It means it started in January to have ended in December. Now we are told to now look for May 2015 to April 2016. Now we have May to December 2015 in this period. First of all, we have May to December. We are looking for May to April of 2016. So they gave us May to December first. So you have to take the profit that relate to this 2015 year. 1, 2, 3, 4, 5, 6, 7, 8. You see? So May to December is about 8 months. So you take that 8 months, 8 over 12 times 180,000 plus how many months do we have left? No, we're looking for May to April. We've gotten May to December, which is in this first period. May to December is here from a total of 12 months. Then the remaining months, January, February, March, April, 4 months falls in this next period. Because this same place will also be from January, February, March, April, May, June, July, August, September, October, November, December. So we're looking for May to April, this April. And they give us a May to December, which they give us January to December here as 180,000, which in this 180,000, it is only the profits that relate to our period we calculate for, which is from May to December, 8 months. Then the January to April falls in this other month, 2016, falls in this second period. 4 out of 12 times what? 240,000. This will give us total of 200,000. Okay. Next, 1st of May 2016 to 30th of April 2017. Same treatment. May 2016 to April 2017. They give us January to December of 2016 year. And remember that it is only May to December that relate to 2016. From this our period, May to March and May to April May 2016 to April 2017. We have January to December of 2016. So May to December is relating to this our period, which is a period of 8 months. So you take the 8 out of 12 times 240. Then the remaining 4 months, January, February, March, April, falls in the next period. A total of how many months here? 16 months period. So plus 4 which is January, February, March, and April over 16 times 336. Okay, 8 over 12 times 240 plus 4 over 16 times 336 will give us 244,000. All right. Lastly, May 2017 to April 2018. May 2017 is still in this 16 months period. Take note, because this is from January to April. So we have May, this 16 months period. Let me bring it down here. It is from January, February, March, April, May, June, July, August, September, October, November, December. January, February, March, April. See, this is 2017 and 4 months inside 2018, all in one period. And now we're looking for May 2017 to April 2018, which is from here. May 2017 to April, which is the last date here, to April 2018. And this is a period of 12 months. Out of a total of how many months here? 16. So it becomes 12 over 16 times 336,000, and that's 252,000. So when you add all of this together, it was 696,000. Okay, so you discover that the new accounting date has an higher accessible profit compared to the old accounting date. So if you are to advise the company, we should definitely give a comment on that the relevant authority will have to assess the business based on the new accounting date, because it has a higher accessible profit of 696,000 over the old accounting date. So we also solve other complex questions. Some questions may not be exactly direct like this. So in this series of change of accounting date, we are going to solve some other technical questions and some past questions from ICANN Pack. So stay tuned to the channel. Ensure you subscribe, like, and share. We'll drop more videos on change of accounting date to ensure you have a concrete understanding on change of accounting date. Thank you very much. God bless you.